As the global economy continues to face turbulence and uncertainty, it's crucial to understand the volatile nature of financial markets. And who's better to guide us through this complex landscape than the renowned economist and author, Jim Rickards? We're going to explore some fascinating insights from Jim Rickards on the dynamic relationship between gold, inflation, and the 10-year Treasury note. We'll uncover how these factors interplay and affect your long-term investments. Gold has traditionally been viewed as a safe haven during economic crises, but in the current climate, it's not so straightforward. With oil prices and bond yields fluctuating, Rickards stresses the importance of monitoring the yield on the 10-year Treasury note as a crucial metric for assessing substantial, long-term investments. As the value of the dollar changes, so does the price of gold. However, inflation plays a less significant role than what you may expect. In this video, Jim Rickards will provide us with valuable insights into the intricate workings of these factors, allowing you to make informed decisions that safeguard your wealth and invest wisely. So whether you're a seasoned investor or new to the game, stay tuned to learn more from the expert himself, Jim Rickards. 1971 was a turning point in the history of gold and its relationship with the US dollar. President Nixon discontinued the practice of redeeming dollars for gold in 1971, effectively making it illegal for Americans to own gold. This decision marked the end of the gold standard, and dollars could no longer be converted into gold by foreign merchants. Before this monumental shift, gold was used as actual currency. Under the Bretton Woods system, the price of gold was set at $35 per ounce, and before that, at $20.67 per ounce. Let's travel back in time to the early 20th century, where 1 pound sterling was equivalent to approximately $4.75. British travelers in 1913, due to the war, still carried the British sovereign, a gold coin weighing about 8 grams, from London to Bombay, now Mumbai. In those days, gold was a true medium of exchange, accepted universally. There was no need to worry about exchange rates, as the value of gold was determined by its weight. People could easily determine the worth of their gold in various currencies by converting it into grams. Gold was a stable and reliable currency for thousands of years. However, the decoupling of gold and the dollar in 1971 raised the question of the dollar price of gold, as the value was no longer fixed. In truth, the transformation from a gold-backed currency to a fiat currency took about 75 years, beginning in 1914 with the onset of World War I. Gold was in high demand as nations like Germany and the United Kingdom needed it to finance their war efforts. The United States, initially neutral in the conflict, did not enter the war until 1917. In the meantime, New York became the center of European military finance. As countries scrambled for gold, people were encouraged to exchange their gold for paper currency, driven by a sense of patriotism. Gold was deposited in banks, which then melted it down into 400-ounce bars. People were assured that their paper currency was still backed by gold, but the sheer weight of the gold bars made them impractical for everyday use. These massive bars, weighing around 35 pounds each, were far too heavy to carry around. So while paper currency was still backed by gold, the physical gold itself was no longer in circulation, having been stored away in banks. This marked the beginning of the shift from gold-backed currency to fiat currency, a transformation that would culminate in 1971 with the end of the gold standard. In the second stage of the gold transformation, central banks took over commercial banks' gold reserves during the Great Depression of the 1930s. Initially, commercial banks collected gold from the people. Eventually, government-run banks confiscated the gold reserves of private banks. The Federal Reserve System facilitated this transfer of gold. People were encouraged to bring their gold to the nearest Federal Reserve Bank. Most of the gold ended up at the Federal Reserve Bank in New York. As a result, gold has become a rare sight for the average person. while paper currency continues to be used as if it's still backed by the precious metal. In the third stage, the U.S. Treasury and other finance ministries seized the gold from the banks. In 1934, the U.S. Treasury took control of the gold reserves of the Federal Reserve System. Despite the Federal Reserve System being privately owned, they received a gold certificate. You can still find this certificate listed as an asset on the Federal Reserve System's website. It's valued at $11 billion, based on a gold price of $42 per ounce. In today's dollars, the purchasing power of $11 billion is around $470 billion. This means the Fed holds a gold certificate representing a $450 billion asset that doesn't appear in its financial statements. However, the actual gold is stored in the Treasury. So, where is the gold kept? In the United States, the Treasury holds the nation's gold reserves. The Federal Reserve only possesses a certificate. The Army safeguards the gold at West Point and Fort Knox, ensuring it remains secure and protected. To put it all together, the history of gold and its transformation can be divided into distinct stages. Gold has transitioned from a widely used currency to a rare and valuable asset controlled by governments and central banks. As gold became increasingly scarce, paper currency continued to be used as if it were still backed by the precious metal. The complex history of gold and its relationship with currencies offers valuable insights into the evolution of money and the global economy. Understanding this history can help us appreciate the intricate workings of financial systems and the role gold has played in shaping them. People carried gold in their pockets, using it as a common currency. Over time, gold moved from commercial banks to central banks, and eventually to finance ministries guarded by the military. Although gold still exists and is stored securely, it's no longer used as everyday currency, and most people act as if it doesn't exist. So, what happened to gold, and how did it become a somewhat forgotten asset? Over the years, the conversation around gold has dwindled. People stopped discussing its significance in monetary systems, and educational institutions ceased teaching about its value. Jim Rickards received his master's degree in international economics in 1974 and was part of the last group of students who learned about the monetary importance of gold. Since then, knowledge of gold has become increasingly specialized, limited to self-taught enthusiasts or students at mining colleges. As gold fell out of mainstream conversation, 2 generations of professors grew up without learning much about it. The subject was buried and left out of many economics courses. However, gold hasn't entirely vanished from the world stage. Countries like Russia still value it, and the United States holds 8,133 tons of gold, just a little more than its original 8,000-ton stockpile. Many countries haven't been involved in the gold trade since 1980. The United States, for example, hasn't sold any gold since then. Other countries like Britain liquidated a significant portion of their gold reserves. The Swiss traded 1,000 tons. The International Monetary Fund, IMF, sold 400 tons in 2010. And Australia and Canada saw massive sell-offs of their gold reserves as well. If the United States followed suit, they might sell some of their stockpile, but they have chosen not to do so. The once prominent role of gold as currency has faded over time. Gold has transitioned from people's pockets to guarded military facilities, while the conversations and education surrounding gold have dwindled. Despite its reduced prominence, gold still holds value for some countries and remains a significant asset in the global economy. Understanding the history and evolution of gold can provide valuable insights into monetary systems and how they have changed over time. As gold continues to exist in the background of modern financial systems, it serves as a reminder of a bygone era and a testament to the ever-evolving nature of money and economies.